Aaron, what are alternative investments?
So alternative investments as a category is sort of challenging to define simply because it's really everything else that isn't publicly traded stocks or bonds. It's all the other types of investments. Some of the common categories that people think about when the word alternative investments is used is hedge funds, bullion like gold or silver, derivative strategies like managed futures, sometimes option strategies, long-short equity strategies, and then you have the private asset categories like private equity, private credit, real estate, etc. So it's important when you're thinking about alternative investments to really understand the subcategory, because there's not a lot of similarity between each of the subcategories. So it's important to isolate down the specific category you're talking about.
And what are the main advantages of alternative investments inside a portfolio?
So as a category, the main reason you'd consider including alternatives into a portfolio is diversification benefit. So when you're building you've heard of the 60-40 portfolio or the 70-30 portfolio. The traditional way was we have a large portion of publicly traded equities and we have a smaller portion of fixed income. And the fixed income serves to create diversification, and we have a certain amount of diversification inside of the equity portfolio. Unfortunately, there's only so far you can go when you're dealing with achieving diversification inside publicly traded equities. So we look further to try to find other categories of investments that have lower correlation to the stock market so that we can continue to improve that diversification enhancement without undermining the performance. In fact, sometimes certain categories of alternatives have a return enhancement element as well.
And what are the main risks associated with these investments?
So this is the big challenge. Unfortunately, in Canada, the alternative space is still somewhat of the Wild West, or is a accident-prone category of the investment world. So it's important when you're moving down this category to work with a partner who has vetted the investment managers that you're incorporating into your portfolio and has a good understanding of those risks. And some of those risks include liquidity risks, how you get your money back, transparency risk, how the portfolio is accurately and fairly valued, counterparty risk, who are the other players that you're transacting with through that investment tool, and also understanding sort of whether or not you're dealing with a senior tier player. There's a lot of smaller players. You really want to be working with those who have an established reputation, have a historical performance you can draw on, and have some sort of a secret sauce or edge in their investment process.
And what type of alternative investments do you consider when building a portfolio?
So typically there's four categories that I consider when I'm looking at building out a alternative segment of a portfolio, which are private credit, private equity, private real estate, and infrastructure. And with those four subcategories, you can really increase the level of diversification and also potentially create a return enhancement if you're dealing with the right tools, and ultimately create a smoother portfolio experience through your investments.